Ladies and gentlemen, good morning. Any recap of last week's action is going to be brief and boring, and really made quite difficult by the fact that we have rolled over to the December contract. The 2-year note has been least affected and shows absolutely no movement over the course of the week. We are completely stuck in the same range that we have been for the past several weeks. The euro dollar shows it even better. We had a mildly positive week, and we suspect that we shall be in this range of 10 to 15 ticks for quite some time. The front contract really should not cross the 99.20 area, nor should it break below the 99.06 area. The other contracts have been made much more difficult to look at because of the rolls, so we shall look really at yield levels. And basically the 10-year note has done absolutely nothing over the course of the past week. We still have this range between 145 and 170 in terms of yields that we have been stuck in for the past, well, for the whole summer really, and we are showing very little sign of busting through it on the upside. The moving averages are catching up and exerting downward pressure, which is really quite predictable, because the market is trying to price in a further rate hike, which might come in September or might come in December, and therefore the market is quite indecisive at the moment. The IEF, which is the closest to the 10-year note that the ETFs come, shows an even tighter range, and basically we are buyers of it against the 111 level, where we have a very clear trend line support, and we have very clear support at 110.40 with a very clear stop loss, which coincides with this range of value of 109.90, and where the 200-day moving average is at the moment. So our value area for buying the 10-year note is anywhere just below the lows it has made. So we're looking to buy around the 111 to 110.50 area, and with a very clear risk reward breakdown level and stop loss below 109.90. In much the same way, TLT, which is the 20 to 30 year sector, is really in no way bearish until we break the 137 level on a closing basis. The moving averages are still pointing upwards. There is very, very little reason to be short of it, and we know where the best value area is. It's just around 137, with a stop on a closing level below 137. That is all we can do at the moment in terms of fixed income. We can pick out value areas to trade. At the moment, price is in limbo, and we do not trade limbos. We invest in limbos. We keep on adding as we have stuff maturing and rolling off. we keep on buying bonds, but we do not leverage buy bonds until we find some value areas to trade against. We don't trade for a living, we invest for a living, and we trade when we have reasons to trade. For the past several months, we've had very little reason to trade fixed income, whether it be European or the US. The bunds and the bobbles are now absolutely untradable from the futures charts because of the rolls, which are all 200 or 300 basis points lower, ticks lower than the previous contract. So they are absolutely meaningless. The only way we can have a look at what's going on is by looking at the yield charts, and we can actually see that in the bund absolutely nothing is going on. It's still stuck in a 10 basis points range between -10 and basically 0, although we could even say -2. We suspect that with the ECB coming up on Thursday, not much is going to change until then. The most interesting thing that we can say about bunds and bobbles is that we think that the next leg up in the stock markets in Europe is going to be motivated by a flattening of the yield curve towards 0. You have the 5-year note at the moment trading, the bobble, the 5 years trading at -54 basis points. Why anybody would want to invest at -54 basis points is beyond me. So as soon as we see that going towards 0, we shall know that people are taking money off the table from the safety of -54, because they're saying, whoa, wow, we're only going to lose 54 basis points over 5 years, this is great, and actually putting money to work in some riskier assets that have higher upside. It is obvious that Europeans have very, very little confidence at the moment, and when that changes, we should be able to see some very large moves in the indices. We still really like beginning to really like the DAX cash charts. This is the 300-minute, and as we can see, we have been, every time we have come down to the 10,450 level, we have bounced off it in no uncertain terms. We have not been able to close below it. That to us is one of the key levels, and the other key level is here. In the weeklies, we can see this wonderful formation that is building up between 10,000 and 10,150. This area is going to be extremely good support, and any dips into 10,150 to 10,000 are going to be great value areas to invest in the DAX for the medium term. We think that this area here is beginning to mirror this area here, and any dip towards this line and these moving averages is going to be a wonderful place to invest for the longer term. If we look at the equivalent in the stocks, we come to the conclusion that we are going to have several more weeks and several false starts before this chart begins to mirror the DAX. Therefore, for the next several weeks and months, we will be favoring longs in DAX over longs in stocks, which does make some fundamental sense because we have some key political events coming up in Italy and in Spain over the next few months, and therefore that uncertainty is going to take time to play out before the stocks is in a position to rally at the same speed or even faster than the DAX. So over the next few weeks we'll be concentrating on DAX longs rather than stocks longs. Now, what to say about the S&P? Well, you have the pattern that you have. You have the Bollinger Bands compressing between 2190, let's call it, and 2160. And you have the moving averages slowly catching up to price action. This is the key 50-day moving average that we would like to be buyers against. At the moment is just below 2150. That is why we think 2150 is going to be very good support, and we would always like to buy the market against 2150 because we have a very clear stop below it. Do we think the market is now going to go and break out on the upside? No, we just don't. We have so much coming up in the next few weeks. We have the Federal Reserve on the 21st, so that's the third week. We just don't see fundamentally how the market can go much higher than 2200. There's just no reason for it and no impetus for it. We have to, however, acknowledge that the weekly picture is getting more and more bullish. We anticipate a couple more retests of the 40 to 50 area, but the longer term picture is definitely brightening in terms of the moving averages, which are beginning to really start to deploy to an upward bias. The longer we stay above the 21, 30, 40 area, the better the longer term picture is going to look. As you can see, the Bollinger Bands have started to spread out, giving even now room up to 2220, and we think that over the course of the next, call it quarter, that is going to be the easiest direction for the market to take. We still think that over the course of the next 2 or 3 weeks there is very little reason for the market to sustainably break 2200, and if it does, it's going to be some sort of a short-term bull trap that the market will at some stage test the 2135 to 50 area, and that will be the time to buy it with very clear stops below the key moving averages. We remain invested in the S&Ps. We are not taking any money off the table. But we just don't think it's time to join the leverage trade upwards, because there is far too much uncertainty that the market needs to digest over the course of the next few weeks before it's ready for the next leg up. The volatilities would actually suggest something very similar. With VXX is actually opening up to the downside, but it has a humongous negative divergence on the RSIs. Do we think VXS has room on the downside? Yes, we do, and it needs to make that room on the downside. So the most before it triggers the negative divergence. what does that imply? That would imply a market which, exactly as we said, takes out stops above 2200, gets people long, and then dumps a good 50, 60, 70 points. Going to retest that value area around the 2130 to 2150. And that would actually then spike the VXX to probably, I don't know, 37, 40, 42, something like that, before it makes another leg lower. We're very, very uncomfortable with this VXX picture. Time might correct this, and it might just go and make new lows on the RSIs as well. We somehow doubt it. If you have a better look of this area, the difference in RSI is so huge that we feel that it has to this will be a negative divergence which will be triggered, and then we will have a quite a decent rally in VXX up to, you know, at least the 38 area at a guess. Again, this just says the next high and buying at the high is going to be quite unwise. That is all that we can conclude from this. What is going on with the dollar? Well, very little. We closed the week very roughly where we actually started it, not even a 1/4% away, and we think we are still stuck in this area that basically has very good support around the 94 area and has very good resistance just above 96.50 all the way up to 97.20. We need really several day closes above or below to give us a trend. We still think that in the long term, if we put up some weekly moving averages, that break is eventually going to come to the upside. But this kind of shape of the moving averages tells us that it's going to be several more weeks, possibly months, possibly the whole of the fourth quarter, third and fourth quarter, before the market is ready to make that break, which we still anticipate will be higher and will carry it to at least 103 to 105 in the final fifth wave of the dollar. That is why we are not going to be aggressive in anything we do here in foreign exchange, because we just don't see the value. Moving on to the fundamental valuations of the stock market, we are right hard against the times 17 forward earnings. This level has never in history been broken without a lot of work at it. We are doing this work, and we do not a priori exclude a move up through 2200, which is sustained, but we think it's extremely unlikely. We're playing the odds, and the odds say that the market remains at this level with breaks down much like here, which are then fully retraced, rather than just busting through the 17 times forward earnings Blue Angel without ever looking back. We find that to be very hard to believe. We don't buy the TINA argument in S&Ps, because the picture is definitely brightening both in Nikkei and in Europe, and the market is definitely buying foreign stock markets much more aggressively than it's buying S&Ps. This might have something to do with valuations, of course, as it should. So we are really not buyers above 2200 on a fundamental basis. We just can't do it. The only drivers of the S&P above 2200 can be these charts here. It can't be energy, it can be financials. We don't quite know what happened here, ignore it. Financials are now at their most overstretched since since 2000. How much more can the financials give us on the upside? We think very little. The one thing that could make the S&P sustain a higher level is a return of the healthcare index to its highs or even slightly beyond. That's why we don't exclude that possibility in the slightest. We think actually it's quite likely that healthcare would actually outperform from now on. The industrials definitely cannot be a driver in our opinion, and technology can continue to be a driver. So what we really need to see for the S&P to sustain gains above 2200 is much more aggressive technology, and even more overbought XLF, which we think is unlikely. I think XLF can probably move 0.5%, 1%, 1.5%, but it can't move the 4-5% that the ES would require it to move to sustain those gains. Materials definitely can't do it, and we think telecommunications might do it, but there's such a small portion of the ES that it's not really feasible for them to take the whole burden onto their shoulders. Utilities might help a little bit, but again they are so small that they can't do it. So we're talking about XLK, XLV and XLF. We just can't see those sectors being able to sustain moves of more than a couple of percent, and therefore that is why we think for the next few weeks it's terribly unlikely that the S&P will be able to sustain gains above the 2200 area. So what are our biases for the next week? IEF, that's the 10-year equivalent ETF, our value area is 111 with a stop below 109.80. That is a very clear trade. The Bunds, basis U16, we still see that as value around 165.60 with a very clear stop below 165, possibly stop and reverse. We shall study that if it happens. DAX is to us the clearest, 10,200 with a stop below 10,000 we think is a great trade, which offers probably 5-6 to 1 risk reward. ES value, again still value longs, 2140, 2150, very clear stop below 2130, and we will be looking to add to our option position or sell outright short above 2200 at extreme spikes. Gold, we still like a break of the stops which will be triggered below 1300 or 1308, and we're looking to buy those as close as possible to 1270. 1290 is an initial point, but the stop is very clear at 1270. So those are our value areas, and we think that's where we think we can make leveraged plays which have more than 2 or 3 to 1 risk reward for the course of next week. Thank you very much and have a lovely Labor Day holiday. Bye.